Looking for a terrific business to invest in for the long haul? Does no long-term debt, a market-beating yield, and a double-digit dividend growth rate sound good to you? Like the idea of buying a high-quality dividend growth stock while it looks undervalued? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Feber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a niche retailer selling high-end home furnishings. Retailing is a tough gig, intense competition, and thin margins. But what if you can differentiate yourself? Well, that's exactly what this company has done. In the process of doing so, it's been racking up more revenue and profit, and that has been leading to an ever bigger dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Williams-Sonoma Inc., which appear to be trading at a significant discount today. Williams-Sonoma Inc., stock ticker WSM, is a multi-channel retailer of high-quality home products and furnishings. Founded in 1956, Williams-Sonoma is now an $8 billion by market cap niche retail player that employs over 16,000 people. The company's reporting segments break down by brand. Pottery Barn, 41% of fiscal year 2022 sales. West Elm, 26%. Williams-Sonoma, 15%. Pottery Barn Kids and Teens, 13%. Other, which includes international franchise operations, accounted for the remaining 5%. Almost all of the company's sales are US based. Retailing has never been more difficult or competitive than it is now. In order to succeed, a modern-day retailer needs two important aspects in order to thrive. I'm not saying these two aspects are all a retailer needs, but I am saying they're critical ingredients. Without them, a retailer will almost certainly fail. One of those aspects is differentiation. If there's no differentiation, a retailer cannot stand out and get the attention of consumers. Well, Williams-Sonoma sets itself apart by providing unique brands within a specialized niche. The company sells a range of high-end home furnishings that offer a certain value proposition relative to the quality. The other aspect is a coherent, cohesive omni-channel strategy. Regarding this point, Williams-Sonoma has been arguably better than any other retailer out there in terms of managing channels. The company's e-commerce channel has long been both its largest and fastest growing channel. Williams-Sonoma has been generating more than half of its sales through its e-commerce channel for years. This channel accounted for approximately 66% of sales for fiscal year 2022. The prescient management of channels positioned the company extremely well for the pandemic, which allowed Williams-Sonoma to hit another gear and accelerate its way through and out of the pandemic. Meantime, the physical retail stores complement the e-commerce channel by showcasing products in the best light possible. With the work from home trend showing evidence of sustained popularity, and with home renovation being something that never really dies out, Williams-Sonoma's foresight is now paying off in a major way. Because Williams-Sonoma has mastered the two aspects I touched on earlier, the company is thriving when many retailers are just trying to survive. And I fully believe that Williams-Sonoma will continue to thrive, which should translate into many years of growth across the company's revenue, profit, and Dividend. Indeed, the company has increased its dividend for 18 consecutive years. Williams-Sonoma is well on their way to becoming a dividend aristocrat one day. The 10-year dividend growth rate is 13.2%, and there has been consistent double-digit dividend growth here. For example, the most recent dividend raise, which was announced in March, came in at 15.4%. This huge dividend growth is layered on top of the stock's market-beating yield of 3.1%. By the way, that yield is 80 basis points higher than its own 5-year average. Best of all, the payout ratio is only 22.1%. It's unusual to see a dividend growth rate this high supported by a payout ratio this low, but that just shows us how much growth the underlying business has been producing. In the face of a possible upcoming recession, this low payout ratio and the cushion it provides is encouraging. I like dividend growth stocks in what I call the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. The yield is on the higher end of its range, while the dividend growth rate is quite a bit higher than I'd usually look for. Very, very sweet. Looking at business growth, Williams-Sonoma raised its revenue from $4.4 billion in fiscal year 2013 to $8.7 billion in fiscal year 2022. That's a compound annual growth rate of 7.9%. Strong. Meanwhile, earnings per share grew from $2.82 to $16.32 over this period, which is a compound annual growth rate of 21.5%. Extremely impressive. This kind of bottom line growth is right up there with some of the world's biggest and best tech companies, yet this is a home furnishings business. It's quite remarkable. A combination of substantial margin expansion and prolific share buybacks conspired to drive a lot of the excess bottom line growth. Regarding that latter point, the outstanding share count has been reduced by nearly 30% over the last decade. Moreover, Williams-Sonoma announced a $1 billion buyback program in March. That's more than 13% of the market cap. Looking forward, CFRA sees a negative 3% compound annual growth rate for Williams-Sonoma's earnings per share over the next 3 years. I must say that's quite the change of heart. I last looked at CFRA's 3-year earnings per share compound annual growth rate projection for Williams-Sonoma back in the fall of 2022. It was 20% at that time. Was 20% too aggressive? I think so, and I argued as much back then, which you can go back and see. All the same though, this new forecast might have swung the pendulum way too far on the pessimistic side. There's no doubt that 2023 is a tough environment, and that could even bleed through into next year. If a recession hits, it's obviously quite easy to hold off on discretionary home furnishings purchases, but 3 years is actually quite a decent chunk of time. Recessions tend not to last for years on end, and this business has shown itself to be very special. Williams-Sonoma builds itself as, quote, the world's largest digital-first, design-led, sustainable home retailer, unquote. It's a thoughtful meshing of design, convenience, quality, and value. The differentiation really does allow Williams-Sonoma to uniquely stand out in the marketplace. I'm cautiously optimistic about the near-term possibilities, but I'm wildly enthusiastic about the business's prospects over the next decade or so. Even if growth is basically flat over the next year or two, the dividend can still grow at a decent clip thanks to a very low payout ratio. And then, once things normalize again, double-digit dividend growth could return. Averaging things out, it's hard to imagine Williams-Sonoma not being good for at least high single-digit dividend growth over the long run. Plus, you're kicking things off with a 3% plus yield. I think that's compelling. Moving over to the balance sheet, Williams-Sonoma has a stellar financial position. The company has no long-term debt. It's a pristine balance sheet. Profitability for a retailer here is exceptional. Over the last 5 years, the firm has average annual net margin of 9% and annual return on equity of 47.9%. I mentioned margin expansion earlier. To that point, net margin was routinely in the 6% area at the beginning of the last decade. It's rare to see a retailer produce high returns on capital, but this is yet another way in which Williams-Sonoma stands out. I see almost nothing to dislike about this business. And the company does benefit from durable competitive advantages, including brand strength, a successful omni-channel strategy, economies of scale, and vertical integration. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Competition is always intense in retailing, although the differentiation does insulate Williams-Sonoma somewhat. There are effectively no switching costs in place, but the company's brand strength should mitigate this risk somewhat by creating a more loyal consumer base. There is exposure to the broader economy in general and the housing market in particular. Since the company's products are mostly discretionary in nature, Williams-Sonoma would be highly exposed to a recessionary downturn. Ongoing kinks in the global supply chain could weigh on near-term results. The company also faces volatility around input costs. Most of these risks are pretty standard for a retailer, even though I don't see Williams-Sonoma as a standard retailer at all. And with the stock down more than 35% from its recent high, the attractive valuation is anything but standard. The stock's PE ratio is sitting at 6.9. That's incredible. It's well below the broader market's earnings multiple. It's also less than half of its own 5-year average price earnings ratio of 14.4. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This is a very conservative number when you compare it to what Williams-Sonoma has proven out in terms of its earnings per share and dividend growth over the last decade. Even the most recent dividend raise came in twice as high as what I'm modeling in. However, I think it's right to be a bit cautious right now. We're in the middle of an unprecedented period for rising rates, which introduces plenty of unknowns about the results of this. The business has been holding up extraordinarily well in the face of so much pressure and change, but the big turbulence could still be ahead of us. Simply put, I'd rather be pleasantly surprised than unpleasantly disappointed. The dividend discount model analysis gives me a fair value of $154.80. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates WSM as a 5-star stock with a fair value estimate of $211. CFRA rates WSM as a 3-star hold with a 12-month target price of $130. Quite a range. I'm somewhere in the middle. Averaging the three numbers out gives us a final valuation of $165.27, which would indicate the stock is possibly 32% undervalued. Here's the bottom line, guys. Williams-Sonoma Inc. is one of the best retailers in all of America. Through differentiation and a successful omni-channel strategy, as well as a pristine balance sheet, the company is set to continue thriving for years to come. With a market-beating yield, a double-digit dividend growth rate, a very low payout ratio, nearly 20 consecutive years of dividend increases, and the potential that shares are 32% undervalued, dividend growth investors should be taking a close look at this name right now. And now for a special news announcement. American States Water Co., stock ticker AWR, just printed a great Q1 report, easily beating on both the top line and bottom line. Both revenue and adjusted earnings per share grew by approximately 50% year over year. And this is a business that provides one of the basic necessities of life, water. We covered this very high quality utility recently, highlighting it as one of the 5 dividend growth stocks to consider owning forever once bought. If you don't yet own a slice of American States Water, now would be a good time to consider changing that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.